Good morning. Thank you.
I suppose we have everyone here. Can you actually see that? Is there any way that that blind can close any tighter than that? Turn it the other way.
Yeah, this one. This one.
So this is what it's like on Saturdays?
Still bright me up.
Can we get anything better with it? The light from the projector? Or is it reflecting something?
Can't do anything with the light on. Never got folks.
So can you guys manage with that, or you get used to it?
Yeah, we used to.
Okay. Right, sorry for the late start on my part. I had intended to be here a lot earlier than I got here, but as things would happen, I had car issues, so I was late in getting out. First of all, let me introduce myself, Pedro Delaney. I don't know if Miguel would have said anything about why he asked me to participate in the lecture on taxation. I'm a Canadian chartered accountant. My experience is that I've worked in auditing firms in Canada and here in the Bahamas for a number of years. And then I got bored with auditing and I went into controllership and worked as the finance manager, financial controller for a number of institutions around town, mostly in the financial services industry, local banks, international banks. And did a stint at the National Insurance Board, which was very interesting. It's always nice to experience government in one bit. And that NIB being a quasi-government was interesting. Enjoyed it actually. Actually, I did enjoy most of it. And then I went back into the private industry. Worked with CIBC during their transition. Well, the merger of CIBC and Barclays. I was part of that team for the Bahamas, Turks and Caicos, and some involvement in the rest of the Caribbean. But I've always had a keen interest in taxes, and in probably 2012 thereabouts, I was part of the board of the Bahamas Financial Services on their board, and I was on their taxation committee, so I got involved in taxes when the Bahamas started talking about reforming its tax structure. And in 2014, I got involved with the Ministry of Finance as a consultant to do some of their training with respect to value-added taxes. So I spent a couple of months traveling around the Bahamas, primarily focusing on the tourism industry. Grand Bahama, Bimini, Long Island, Cat Island, Abaco, Anchors, doing some presentations for them on value-added tax, leading up to the implementation of value-added taxes. I don't know, do we have any attorneys? On one of my trips back from one of the Founding Islands, I was called and said, well, the Bar Association is having their presentation on value-added taxes. Can you come over and assist the presentation that's going on? So I had just flown in and went, and I sat there for the first half an hour. It amazed me that attorneys who deal with legislation, it was very apparent that they hadn't read legislation. The questions they were asking was very indicative of the fact that they had no idea what was actually in the bill at that time. So I don't say, I know the majority of attorneys are well versed with legislation, but that was just a bit astonishing. So I've done a number of presentations on that. Over the last couple of years, the VAT has changed a bit. But what I'm interested in doing now is not only to focus on VAT, but I will start a series of lectures dealing with taxation more generally, and then also highlighting the particulars of value-added taxes. I am a consultant. I do work for myself most of the time. I had started a practice doing associates as indicated on the chartered accountant, because I am a member and past council member of the Bahamas Institute of Chartered Accountants. As I said, I've been on a couple of boards, all that sort of stuff. So that's who I am. Now, why don't I understand a little bit about who you are? I know you guys have been together. This is probably your second. This is your second class. So, if you were presented with the overall agenda for this particular course, you would realize that this taxation module tends to come to us here. So we've shifted it a little bit. So it's probably a little bit earlier than we expected. So, why don't we start with introductions?
My name is Joshua McFall. I am 22 years old. I'm on the national team for the Bahamas. I also have my own company. It's called Natural Bodies. I do all natural drinks, weight gainers, detox, and I'm also working on a drink for cancer patients and smokers as well.
Do you have weight loser drinks as
Yes,
well?
sir, weight loss.
Okay. Some of us might be interested in that. Okay, and you?
My name is Attorney Taylor. I'm a compliance officer.
Can't stay with home? Or? No, I'm not gonna press you. All right, and behind you.
My name is Sept. I work for Scotia Wealth and on the securities team. And I'm just curious about taxations and how it affects IRS and the reporting of CRS and all the new stuff. So to keep me current, that's why I'm reluctantly in the classroom.
That's why you're what?
Reluctantly in the classroom. The good thing is this course ends before Christmas. I could do this.
I'm sure you will find that taxation is very, very interesting. That's what they told me about the
Mhm.
county.
Well, that's one of the things, you just have to keep current, so I'm here.
Okay, very well. And behind you?
My name is Kimberly Evans Clare. I'm employed with PwC, not in audit. I work in the corporate service system department.
Okay.
Focus on corporate tax, legal tax, and compliance.
Great, I almost, when I saw PwC, I almost said federal accountant. Okay, and what's up?
Cindy Curtis. I'm employed with Commonwealth Bank, head of compliance and another role. And like she said, just remaining current, up to date on CRS, FACO, that.
Very good, and behind you?
My name is Javon Pratt. I'm a credit officer at Delta Bank and Trust. Like the ladies before me, do a lot of CRS and factor reporting, so I'm here to keep abreast of what's happening with the gain up and understanding of it.
Very good. Deltec is very nice. I did their audit for many years. Back in the day, as my sons would say. They're still the group that I imagine they were. They used to
There's
have
been
their
quite a
trading
bit of
offices in New
changes.
York and in London. So Mr. Dauphin was a lot more.
Oh, that was me back in the day.
Clarence and Benny Dauphin.
Yeah, that was me back in the day.
All right, and next to you?
I'm Anya Charles, and I'm a compliance officer at Delta Gotham. And I express my sentiments, same as the colleagues here.
You just want to learn about taxes and get so
I
excited.
need to stay current as well, yeah, you have to have the CRS.
You have no other choice.
Yeah. Well, my part of the course is dealing more with the local taxation. So the international portions, I guess, will be done by the other lecturers as they start to do their presentations. But I'm going to focus on the local stuff. Let's see if I can get this started. So, I'm going to talk in my series basically on taxation, the tax policy in the Bahamas, tax revenue issues in the Bahamas, taxation and FDIs, value-added tax itself, and value-added tax administration as it is outlined in legislation for the So,
Give out the handouts first. We can follow those.
You can make notes.
Yeah.
thank you. I was gonna have handouts.
People who
I mean,
Yes.
I asked.
Hey, you can keep all that paper to yourself.
Thank you.
So basically, those are just printouts of the slides that I'm using. So this is what the 3 Saturdays that I'm scheduled to do is going to look like. Today we're going to address items 1 and 2. Next Saturday we'll address item number 3, and then the following Saturday 4 and 5 together. So let's start. Taxation. What is taxation? I know you had your early class last week, but what does it mean to you or the average citizen in a society when you hear the words taxation? Well, the Encyclopedia Britannia defines taxation as the imposition of compulsory levies on individuals or entities by governments. So that's a very rigid definition. The Oxford Dictionary describes taxation as a compulsory contribution to state revenue levied by the government on workers' income and business profits, or added to the cost of some goods, services, and transactions. Slightly different definition by Oxford. I, however, wish to adopt a definition that encompasses both. So I like to say that taxation is the principal method by which government obtains revenue into its fiscal budget to finance its expenditures by imposing charges on citizens and on corporate entities. To me, that's a little bit more of a comprehensive definition. So taxes are levied in almost every country of the world, primarily to raise revenue for government expenditures, although they serve other purposes as well. Revenues collected is used for a vast number of items. One, it's used for recurrent expenditures such as to pay ongoing expenses of the government, salaries, rent, utilities. 2, for capital projects, and that is to build buildings, to construct roads, to do all of those major things that are not supposed to have to happen every year. And thirdly, to repay debt. Of course, this debt can be local debt or I should say, and foreign debt. In the Bahamas, as you would know, our government is indebted to a number of financial institutions, including the National Insurance Board, probably almost all of the local banks, and then in a rather and comfortably less amount indebted internationally. I think that's one of the saving graces for the Bahamas, that most of our national debt is actually local. And that's a big distinction between the Bahamas and a number of other countries, particularly in this region. And that's why the Bahamas has not faced the kinds of international pressures that other jurisdictions like the Barbados and even Trinidad many years ago did, and certainly Jamaica as well. So in modern economies, taxes are the most important source of governmental revenue. Taxes differ from other sources of revenue in that they are compulsory and are unrequited. I can't pronounce that correct. The attorney, you're the attorney. Now that word we know means that it's something that's unreciprocated. So that means that they are generally not paid in exchange for some specific thing, such as a particular public service, the sale of property, or the issuance of public debt. So while taxes are presumably collected for the welfare of taxpayers as a whole, the individual taxpayer's liability is independent of any specific benefit received. I think most of us understand and can relate to that we are paying taxes to fill the consolidated fund. We're not paying it for any specific purpose. However, there are some important exceptions though. You do have payroll taxes, for example, which is levied on income in order to finance things like retirement benefits, pensions, medical payments, and other social security programs, all of which are likely to benefit the taxpayer. But because of the likely link between taxes paid and benefits received, payroll taxes are sometimes called contributions, such as national contributions in the Bahamas, national insurance contributions. Nevertheless, the payments are commonly compulsory, and the link to benefits is sometimes quite weak. We're all familiar with the national insurance contribution. We know it goes towards our short-term and long-term benefits in terms of one, I wouldn't even say pensions, but it's really income replacement. Income replacement on a long-term basis and income replacement on a short-term basis. That's the primary role of national insurance. Of course, there are other things, other benefits that has been added from a social perspective, such as maternity benefits, more recently unemployment benefits, funeral benefits. Well, that's been there for a while. But those are all added benefits to national insurance. Its primary role is to replace income, to replace it on a short-term basis when contributors are temporarily out of work, or because of illness, or as the recent addition was because of just not having a job, unemployment, and then long-term in terms of providing a pension. So another example of the tax that is usually linked, if only loosely, to benefits received is the use of taxes on motor fuels like gasoline. Now, this is not the case in the Bahamas, but it's just an illustration for you to think about. These taxes are used to finance the construction and maintenance of roads and highways in some of the other developed countries. So these services can be enjoyed only by consuming the tax motor fuel. So that's the linkage. The linkage is that in order for me to benefit, I have to purchase or I have to consume this particular item that's being taxed, gasoline. So the taxes derived from gasoline in many of the developed countries go towards the maintenance of the roads that persons who consume the gasoline are benefiting from. That's one of the linkages between taxes and benefits. Here, we don't have that luxury. And we do have a significant tax on our fuels. The general public became a lot more aware of that a couple of years ago when we started having the increases in gasoline prices, when we realized that I think the government profits the most from gasoline than the wholesaler and the retailer. So, we understand that generally taxes, which are compulsory, are not linked to anything. It's just general contribution that you make towards the overall expenditures of the government, except in the case of maybe one or two areas where there are some benefits to be derived from having paid taxes. But during the 19th century, the prevalent idea was that taxes should serve mainly to finance the government. However, governments have utilized taxation for other than merely those fiscal purposes. Governments also use taxation to encourage or to discourage certain economic decisions and actions within their countries. For example, in an income taxation system, the reduction of taxable income of an individual or a family by the amount of interest paid on a home mortgage may increase construction activity and thereby create more jobs in the economy. Therefore, taxation can be used to stimulate economic activities as well. Another example would be the granting of a tax credit to households who install solar water heaters to encourage families to purchase such products, and in this case, to also benefit the environment. So we can use tax measures or tax methods to cause certain reaction in the economy, to cause consumers to behave differently. Generally, the ability to do that is generally reserved to areas like income taxation, where there's a direct tax. Many years ago, Barbados had wanted to have most of their residents, their households, switch to solar water heaters. They had a local producer of the solar water heaters in Barbados, and I guess the industry was able to persuade the government to provide tax credits. So anyone who installed the solar water heater automatically got a certain tax credit, which is a break, just an allowance, a reduction on your tax liability. And obviously, by the government doing that, it caused more persons to go out and buy solar water heaters. And if you were to travel to Barbados and you look at the rooftops, there are many, many solar water heaters. It causes one to wonder, why can't we do a similar thing here in the Bahamas? We have just as much sun, almost as much sun. Barbados is a lot closer to the equator than we are, but we have a lot of sun. So we can benefit from that as well. But again, the point is that in some respect, the government can use tax methods in order to cause certain things to happen within the economy and for certain industries. Any questions? That's all fairly basic. So, let's look at different types of taxes. You heard me mention just now direct taxation. So we have what we call direct and indirect taxes. What is direct and what is indirect? The well-known economist Atkinson stated that direct taxes may be adjusted to the individual characteristics of the taxpayer, whereas indirect taxes are levied on transactions irrespective of the circumstances of the buyer or seller. That's very comprehensive. Direct taxes may be adjusted to the individual characteristics of the taxpayer, Indirect taxes, however, are levied on transactions irrespective of the circumstances of the buyer or the seller. So, a direct tax is paid directly by an individual or an organization to the imposing taxing authority. Indirect taxes is a tax collected by an intermediary from the person who bears the ultimate economic burden of the tax. So, let's examine that a little bit more. Direct tax is a tax that is paid directly by an individual or organization. The taxpayer pays a direct tax to a government for different purposes, including income tax, real property tax, personal property tax, or other taxes on assets. A direct tax cannot be shifted to another individual or entity. The individual or organization upon which the tax is levied is in fact responsible for the fulfillment of the tax payment. Hence the term direct. Indirect tax, on the other hand, can be shifted from one taxpayer to another. In this case, the tax is levied on one entity, such as a seller. The seller has the responsibility for the taxes, but it's paid by another entity or individual, such as the customer. For example, a sales tax paid by the customer in a retail store. So, the retail store is responsible to the taxing authority for the taxes. But the sales tax is actually paid by the customer of the retail store. So, the retail store has the ability of shifting that tax to the consumer or the customer. And it's acting as an intermediary in collecting the taxes, fulfilling its responsibility by onward paying it to the taxing authority. So indirect taxes are charges levied by the government primarily on consumption, expenditure, privileges, or rights, but not on income or property. Income or property meaning more generally assets of an individual, assets of a company. For example, I shouldn't say example, customs duties levied on imports, excise duties on production, sales taxes or value-added taxes at different stages of production and distribution are examples of indirect taxes, because they are not levied directly on the income of the consumer or the earner. So those items are indirect. A tax that increases the price of a good or service so that consumers are actually paying the tax by paying more for the product is considered an indirect tax. An indirect tax is most often thought of as a tax that is shifted from one taxpayer to another, as I said earlier, by way of increasing the price of the good or the service. Tax on fuel, tax on liquor, tax on cigarettes are all examples of indirect taxes, as many may argue that the tax is actually paid by the end consumer by way of a higher retail price. The import duty on cars is paid in the first instance by the wholesaler, the retailer, who actually brings the car, in this case, into the country. But ultimately, the wholesaler, the retailer, transfers that burden of the duty to the buyer of the car in the form of a higher price. So when they sell the car off, the duty that they would have paid, taxes, income, import duties, which are taxes, are shifted now to the end user, to the consumer. So that tax, in fact, is an indirect tax which has been shifted or passed on. Indirect taxes can also be defined as fees that are levied equally upon taxpayers, no matter their income. This is a primary reason why they are thought of as taxes that are passed on, as the price of the tax is compensated for by simply increasing the overall price of the good or service. An indirect tax, such as sales tax, value-added tax, or goods and services tax, GST, which is the term used in some of the other countries, is a tax collected by that intermediary, such as a store, from the person, and the ultimate economic burden is then passed to the customer. So, basic distinction between the two is direct taxes is a tax which is levied directly on one's income or wealth. On the other hand, indirect taxes are mainly consumption-based tax collected by an intermediary. So, since we understand all of that, let's categorize these various taxes as to whether they are direct or indirect. Starting with income tax, direct or indirect? Capital tax.
That would be direct.
Those who think direct, raise their hands.
That relates to the corporation.
Those who think it's direct.
I think so.
Capital tax. So that's a tax that's levied on either income or appreciation of the value of an asset. So it is direct. Value-added taxes. Indirect?
Yep.
Yes, it's indirect. It's similar to a sales tax. Customs duty. Indirect? Indirect, because it's passed on. Okay. National insurance contributions.
Direct.
You seem pretty confident of that.
Yeah.
Yes, it is direct because it is levied on the income, same as payroll taxes. Excise duties. Nobody's asked what is excise duties. Everybody understands what excise duties is. Well, I always thought that was a strange one. Well, excise duties are similar to customs duties, except it's something that's levied inland. So, for example, like a Commonwealth brewery, they produce alcohol, but they're levied an excise tax on the volume that they produce. Whereas customs duties would be levied on the volume of the items coming into the country, crossing the border. The excise taxes is levied based on the production and stuff within the country or the borders. Thought I had a proper definition for it. I think it's probably later on in the notes. So, real property tax, let's continue. Real property tax, direct or indirect? Direct. Gasoline tax.
Indirect.
Insurance premium tax. Insurance premium tax. Is that your final answer?
I think it's direct. Direct.
It is indirect. insurance companies collecting the taxes from their customers. So that's fairly straightforward. Well, let's now look at another way in which we categorize taxes. Progressive versus regressive taxes. And I'm sure all of you heard a lot about how progressive or how regressive our taxes are. Probably more so the latter. How regressive. So these taxes can be classified as being progressive or regressive. A very important feature of a tax system is the percentage of the tax burden as it relates to income or consumption. The terms progressive and regressive are used to describe the way the rate progresses from low to high or from high to low. The terms describe a distribution effect. So as it said, a progressive tax is one where the average rate of tax rises as income rises, and that is the proportion of your income paid in tax rises as your income rises, as you become richer. A regressive tax is generally a tax that is applied uniformly and is unrelated to your level of income. The result is that the average rate of tax is greatest for those at the lower level. So, a progressive tax is a tax imposed so that the effective tax rate increases as the amount to which the rate is applied also increases. Of course, the opposite is that the regressive tax is where the effective tax rate decreases as the amount to which the rate is applied increases. So, progressive So the progressivity is based on the notion of the ability to pay. Progressivity is based on the notion of ability to pay. That people on higher gross incomes are better able to make a bigger contribution to the financing of the collective public and welfare state. As it says, the supporters of progressive taxes argue that such a system is equitable and that progressive taxation can and should be used to redistribute income within a society so that the final distribution is more equal than the original one. That is, that redistribution should be a goal of social policy. So that's a very socialist perspective. Those who earn more in an economy or a society should be prepared to contribute more to the government, and in effect, result in a redistribution of the level of income. These days, we hear so much of the Democratic Party and Republican Party. I would say that's a Democratic perspective, certainly not the Republicans' perspective. The Republicans' perspective would be, the more I can earn, the more I should keep. And that's what often said. I mean, some of you are in the international financial arena, and in the Bahamas we often say that the Bahamas does well when the Republicans are in power. Because they're more concerned with protecting their wealth, and they're more lenient towards those jurisdictions that help them to protect their wealth, which is different from the Democratic, who feel that there should be a redistribution of that wealth. And in the Bahamas, because we are considered a tax haven and regrettably considered a no tax haven, a zero tax haven, the Democrats tend to want to come after the Bahamas. And we've seen that a lot when the Democrats have been in power, even during the Obama era. When we get on into talking about our tax policy in the Bahamas, we'll have a bit more to say about that. So, as I said earlier, a regressive tax is generally a tax that is applied uniformly and is unrelated to one's income. It takes a larger percentage from low-income people than from high-income people. The result is that the average rate of tax is greatest for those at the lower end of the income scale. So this means that it hits lower income individuals harder, and therefore it is hardest on those least able to pay. Some examples would be a sales tax. For example, if a person has $100 of income and must pay $10 of sales tax on groceries, this therefore represents 10% of that person's income. However, if the person now has $200 of income and is still required to pay $10 worth of sales tax, this now only represents 5% of that person's income. Sale taxes that apply to essentials are generally considered to be regressive because expenses for food, clothing, shelter tend to make up a higher percentage of a lower income consumer's overall budget. In this case, even though the tax may be uniform, such as a 10% sales tax, lower income consumers are more affected by it because they are less able to afford it. Regressive taxes rarely are designed specifically to have that effect, but they have such a result because of the spending patterns and choices of the people affected by such taxes, which is reflected in the percentage of their incomes allocated towards specific goods and services. So, let's take another look at our different types of taxes. And let's determine which ones are progressive and which ones are regressive. Income taxes. Regressive or progressive?
Progressive.
Progressive, yes. Capital tax. Value-added taxes.
Regressive.
Customs duties. Import duties. So we're saying that customs duties is progressive.
Progressive.
Is that your final answer? Well, as they say, would you like to call a friend? Okay, in customs duties or import duties, otherwise known as border tariffs, are regressive. They're regressive. reason being that they affect the price of goods. And it doesn't matter the consumer's level of income. They have to buy a good, they have to buy a good. So it's regressive. Excise duties.
Progressive.
No, that's gonna be
Excise duties.
progressive.
Okay, so let's
But you said,
let's go back.
isn't excise duty similar to customs duty?
It's based on.
Progressive tax is one where the average rate of tax rises as income rises. That is, the proportion of your income paid in tax rises as your income rises. Progressivity is based on the notion of ability to pay, that people on higher gross incomes are better able to make a bigger contribution to the financing of the public debt. So that is progressive. Excise duties or taxes is similar to customs duties. Customs duties is when you're crossing the border with this stuff. Excise is when you're creating it within your borders. So it is regressive because again, it's simply added to the price of the goods. But it's on the volume, but it's the manufacturer is responsible for paying it, but they're going to collect it when they're going to pass on, they're going to collect it when they sell the goods, and the price is going to go up because there's an element of taxes in it. Real property tax.
I think that's regressive. Because it doesn't have anything to do with it doesn't have anything to do with your income. So I feel as though it's regressive.
But it has to do with your wealth.
Exactly.
So if I earn more, I can go out
So
and
if
buy
you're gonna buy
more real estate.
Okay, alright.
So it's attached more to it. Real property tax is progressive.
Okay.
Gasoline tax.
Regressive.
It is. I'm going to go on with something else. Many hidden taxes also have regressive effects. Examples might include energy companies charging higher prices for consumers who do not pay using a debit or credit card. So you understand why that might be considered a hidden regressive effect? The reality is that the persons who do not have the ability to pay by debit or credit cards are generally the poorer families. Persons without bank accounts or without persons who don't utilize the official, the formal banking sector. And I thought I would throw this one in. What about energy companies charging a late fee? Is that a hidden regressive effect? BPL charging a fee because your bill was not paid on time. The reality is, lower income consumers may simply not be able to pay their bills on time, and therefore they end up incurring a late fee. That late fee, in effect, increases the overall cost of the energy. So a penalty can have the same effect as an inherently regressive tax. Because I don't earn sufficiently, or I don't have a job that allows me to collect a consistent amount of income, I may not be able to meet my monthly bills to BAC, BPM, and I have to pay an extra fee. Actually, it's BTC now. The charge is $5 whenever you're late.
Thank you.
Well, cable. I oftentimes wonder, one of these days I'm going to try and see if I can analyze their financials and see how much revenue they make from these late fees. I really think it's something that ought to be taken up by ERCOM. But anyway, that's aside. So, did you notice any similarities between progressive, regressive taxes and direct and indirect taxes? If you were to take that same list of different types of taxes and compare the progressive ones with the list as to what's direct and indirect, I think you would find that generally direct taxes are progressive. Indirect taxes are inherently regressive. Direct taxes are levied on income and property or assets. Income, property, and assets are components of wealth. Indirect taxes are generally based on consumption. So, inherently, consumption-based taxes are regressive taxes. Consumption-based would be my sales tax, my value-added tax, my customs duties, because I have to consume something and pay a tax. On the other hand, my ability to earn and my level of earning capacity, when that's taxed, that's a direct tax. The more I earn, the more I can contribute. So there is pretty much a fairly close correlation between direct and indirect taxes and progressive and regressive taxation. Fairly straightforward. I think we go until about 1 o'clock.
Just to see if you would.
No, I just wanted to see how much you were enjoying it. only one person showed us surprise. I must say that's the person who is reluctantly here. Okay. All right, so we've talked about the different types of taxes, how we can classify them, essentially what is taxation, and why we have to have taxation. So let's talk about tax policy. And let's look at principles as it relates to a tax policy. When developing tax systems, consideration must be given to principles which have traditionally guided such systems. In his book, The Wealth of Nations, the 18th century economist and philosopher Adam Smith attempted to systematize the rules which should govern a rational system of taxation. Although restated over time, these basic rules remain very relevant in today's tax system. These rules of Adam Smith are embedded in the principles identified by the OECD as fundamental principles of taxation in 2014. We all know what the OECD is. It represents about 34 countries. But the OECD presented their what they call overarching principles of tax policy. So in its 2014 publication, the fundamental principles of taxation identified 8 principles which should be considered in the design of a tax policy. 1, neutrality. 2, efficiency. 3, certainty. 4, simplicity. 5, effectiveness. 6, fairness. 7, flexibility. And 8, equity. So in a context where many governments have to cope with less revenue, increasing expenditures, and resulting fiscal constraints, raising revenues remain the most important function of taxes, which serve as the primary means for financing public goods such as maintenance of law and order and public infrastructure. So still the principal reason for taxation is to raise revenue to run government. So let's look at these principles a little more closely. Neutrality. Taxation should seek to be neutral and equitable between all forms of business activity. A neutral tax will contribute to efficiency by ensuring that optimal allocation of the means, that is resources of production, is achieved. So essentially, for neutrality, taxes should not favor any one group or sector over another, and should not be designed to interfere with or influence individual decision making. Taxes should be neutral. So in this sense, neutrality also entails that the tax system raises revenue while minimizing discrimination in favor of or against any particular economic choice. This implies that the same principles of taxation should apply to all forms of business while addressing specific features that may otherwise undermine an equal and neutral application of those principles. The economists like that term, because basically what they tell you is that they don't want your taxation system to determine how resources are used within an economy. How productive resources, which could be labor, is shifted from one industry to another. Taxes should not be the determining factor, but rather the ability to generate revenue or profit should be the determining factor. Of course, all of these principles are going to be tweaked in any taxation system, because I said earlier, one of the things that we do with a taxation system is that we try to direct certain kinds of economic decisions. And by so doing, we are tweaking the neutrality aspect of the tax system, because we want persons to go and buy solar products and reduce the impact on the environment. So we are pushing more of the spending towards solar products. So then we will come to find that all of these principles, as they are overarching principles, they tend to get tweaked according to what a particular country or government wants. And then we have efficiency. Basically, which says the compliance cost to business and administration costs to the government should be minimized as far as possible. So tax collection efforts should not cost an inordinately high percentage of tax revenues. Now I recall when the value-added taxes were to be introduced, there was a particular businessman that basically was shouting in the public space that value-added taxes was going to be very inefficient, because it will mean that the government has to go and hire about 50 accountants in order to manage value-added taxes. Now, if that was the case, then yes, it's inefficient, because the cost of collecting that tax just went up. And therefore the net effect, the net benefit is going to be significantly reduced. And then we have the other two, we have two more principles, there being certainty and simplicity. Certainty that the collection of taxes should reinforce their inevitability and regularity. Simplicity, tax assessment and determination should be easy to understand by the average taxpayer. So these two tend to go together. That tax rules should be clear and simple to understand. That's basically what it's saying. It should be clear and simple to understand, so that taxpayers know where they stand. A simple tax system makes it easier for individuals and businesses to understand their obligations and entitlements. As a result, businesses are more likely to make optimal decisions and respond to intended policy choices. This is also very important when we look to foreign investors coming in. One of the challenges for foreign investors is that they're not sure what is going to be their tax burden, what is going to be their formal tax burden and their informal tax burden. And I'll leave that there. So let's look at the other four remaining principles. Effectiveness. And effectiveness and fairness tend to go together. The taxes should be just enough to generate revenue required for provision of essential public services. Taxation should produce the right amount of tax at the right time. Fairness. The taxes should be spread over as wide as possible the section of the population or sectors of the economy to minimize the individual tax burden. That's significant for the Bahamas. And I will ask you to bear that in mind. Fairness. Taxes should be spread over as wide as possible the section of the population, as wide as possible the population or sectors of the economy to minimize the individual tax burden. So, for effectiveness and fairness, taxation should produce the right amount of tax at the right time while avoiding both double taxation and unintentional non-taxation. In addition, the potential for evasion and avoidance should be minimized. If there is a class of taxpayers that are technically subject to a tax, but are never required to pay the tax due to inability to enforce it, then the taxpaying public may view the tax as unfair and ineffective. As a result, the practical enforceability of tax rules is an important consideration for policymakers. In addition, because it influences the collectability and the administrability of taxes, enforceability is crucial to ensure efficiency of the tax system. Enforceability is crucial to ensure efficiency of the tax system. Flexibility. Taxation systems should be flexible and dynamic enough to ensure they keep pace with technological and commercial developments. It is important that a tax system is dynamic and flexible to meet the current revenue needs of governments, while adapting to changing needs on an ongoing basis. This means that the structural features of the system should be durable in a changing policy context, yet flexible and dynamic enough to allow governments to respond as required to keep pace with technological and commercial developments, taking into account that future developments will often be difficult to predict. So you can't have a rigid tax system. You have to have components of your tax system that you can adjust. You can turn it up a little bit, you can turn it down a little bit, that can respond to the advances in technology or the expansion of commercial development. And that's, again, very, very important. And I would submit that in the Bahamas, we really need to look carefully as to what makes up our tax system. Lastly, equity. Taxpayers in similar circumstances should bear a similar tax burden, and those in better circumstances should bear a large part of the tax burden. This equity is something that's broken out into horizontal and vertical equity. So horizontal equity would suggest that taxpayers in similar circumstances should bear the same or similar tax burden. Vertical equity would say that taxpayers in a better circumstances should bear a larger part of the tax burden. That's the progressivity of it. Vertical, that as your circumstances improve, you should pay more in taxes. And likewise, as your circumstances deteriorate, your tax burden should be less. And this is all measured against your income. So in practice, equity is traditionally delivered through the design of the direct tax system. That's how you achieve equity, by having components of direct taxation in your policy, so that you can, if you're in better circumstances, your tax burden is greater. If you're in worse circumstances, or worse, lower income, your tax burden is lower. If you're level, and everyone on the horizontal line should have similar levels of taxation. So in summary, tax policy choices often reflect decisions by policymakers on the relative importance of each of these principles, and will also reflect wider economic and social policy considerations outside the field of taxes. So, tax policy choices reflect decisions by policymakers on the relative importance of each of these principles. And that's why I said that they will adjust. They may be a little bit neutral, or they may move a little bit to the left or a little bit to the right, depending on what they wish to accomplish. But also that's the flexibility within the tax system, that as circumstances change, you must be able to tweak your tax system. Tax policy choices often reflect decisions by policymakers on the relative importance of each of these principles, and will also reflect wider economic and social policy considerations outside the field of taxes. That last part just brought to my mind some of our recent tax policy decisions, which are geared apparently towards certain social steering. And that is the matter that's before the courts now, where a certain amount of taxes have been levied on workshop operators and workshop users. But that's all coming from a social, as I understand it, or as has been said in the newspapers and whatnot, it's all coming from a social perspective. And the same thing with other consumption taxes, because that's what it is, a consumption tax. If you don't use those facilities, you don't pay it. But it's the same thing with the, but it is considered within the category of sin taxes. So the same as alcohol taxes or cigarette taxes. But governments always take account of the social steering and will use taxes to the extent that they can to steer societies in a certain way. So you see how important a tax policy, a tax structure or system is for an economy and for a society. So it begs the question. In the Bahamas, what is the Bahamas' tax policy? Do we have a tax policy? I submit, no. We don't have at least a written tax policy. And whether by design or not, the Bahamas has employed various types of indirect taxation to raise revenue. Traditionally, the Bahamas has been adamantly against the introduction of direct taxes on income. We do not want income taxes. We've said that for probably 40, 50, about 50 years. We don't want income taxes. Generally, the government has considered a plan for its revenue needs during the preparation of the annual budget, in which time it determines the level of taxes it's going to levy on its citizenry. And a significant component in the Bahamas' unspecified tax policy is the granting of tax concessions to attract foreign direct investment, our popular FDI. So in my estimation, these are the essential attributes of what I deduce to be the Bahamas' implicit, that is unwritten, tax policy. Do you agree? Or do you think that we have a particular tax policy and strategy? I searched and I couldn't find anything that said coming up with the Bahamas tax policy. Some countries have it. Some countries have written out what their tax policy is. And it's generally based on how they see their society from a social perspective, how they see their economy, and how they see their economy growing. Also, what they want to attract into their economies. But we haven't done it. But over the last, I want to say from the probably mid-50s, 60s, we have pursued a certain level of taxation. Certain types of taxation. I tend to ascribe it to being part and parcel to the Stafford's model. Although his model was one for tourism, it embodied an economic model as well, which the country has followed blindly for far too long. So, to better understand what our tax policy is in the Bahamas, let's look at the major types of revenues collected by the government of the Bahamas as taxes, fees, and charges. So the taxation policy for us extracts its taxes predominantly from the domestic economy, as can be seen from the nature of the taxes, as well as the quantum, such as customs import duties, excise taxes, and property taxes. Remember, one of the principles was to spread the taxation burden over as much as possible of the population and the economy. But again, it's my view that the Stafford-Sands model was one where it exempted foreign income, foreign investments, and it levied taxes on the domestic economy. But we know that a significant portion of our GDP is generated in foreign investment. And the foreign investment is more softly taxed. And it's again interesting in recent times, since the last budget, that there are a number of instances where one can argue that our tax policy is not equitable. It's not fair, because we concentrate on the domestic, and then even within our residential sectors, we decide which ones we're going to tax more and which ones we're going to tax less. And I'm trying not to be very specific. And then it goes back to, well, the government's entitled to do that, but you have to wonder why. So, the types of taxes employed in the Bahamas are mostly indirect consumption taxes, again, such as customs, import duties, excise taxes, and even business license tax. And we can talk about that. We'll talk about that a little bit more. So, as seen from the revenues collected in the administrative years of 2012, 2013, and I'm particularly using the pre-VAT years. Prior to the introduction of VAT, the largest chunk of revenues obtained from customs duties being 24–27%. So most of the government's revenue was coming from customs duties, which is a consumption-based indirect tax. The second largest amount of government revenue is coming from excise taxes. So for all intents and purposes, you can probably lump those two together. And collectively, these two areas provided 41–45% of the total revenue of the government. So almost half of the government revenue came from just duties. After the introduction of the value-added taxes, which is another indirect consumption-based tax, in January 2015, this value-added tax became the predominant revenue-generating tax for the government. And during the administrative year of 2015–2016, the VAT collected amounted to 33% of the total revenue for the year. Now I refer to the 2015–2016 year because, as you know, the government's financial year goes from July 1 to June 30th. That was introduced January 1 of 2015. So for that year, 2014, ending June 30, 2015, there would have been a half a year of that. I didn't even show that year here for comparison purposes, but rather the full year of 2015–16, where 33% of the government's revenue came simply from VAT. What's also interesting to note is that we said customs and excise, import duties, excise taxes were accounting for between 45%. So in 2013, 2014, we have the 41%. Notice in 2015, 2016, that now drops to 26%. Because we've introduced VAT. And at the time of the introduction of VAT, customs duty rates came down. Now, a lot of people tend to look at VAT as being just a singular add-on tax, a singular additional tax revenue for the government. The reality is that value-added tax has affected a lot of the lines. A lot of things have shifted. Value-added tax is intended to be a very comprehensive consumption tax with the intent of shrinking the quantity of different taxes and rolling them into value-added taxes. So things like this, hotel room tax went away because it was a value-added tax. Instead, you will see that for 2015, 2016, there was no longer a hotel room tax, but guests were paying VAT. Another one that's impacted actually is stamp tax. Stamp tax, in some aspects of it was replaced with just value-added tax, I believe, even on real property. Initially, there was not going to be VAT, and then it was decided that the VAT would roll on to real property conveyances as well. So 7.5% of what was the 10% of stamp duty on real property conveyances was paid as VAT. And so the stamp tax there reduced. But the point here is to really show where the government gets its revenue from. Consumption-based taxes. Predominantly domestic economy taxes, or taxes on the domestic economy. Let's talk a little bit about what these types of taxes are. I mentioned earlier excise taxes, and I did have a definition of an excise tax is an inland tax on the sale or production for sale of specific goods within a country. Excises are distinguished from customs duties, which are taxes on importation. Excises are inland taxes, whereas customs duties are border taxes. I believe I still have an hour or so to go, right? An hour and a half. Okay, so basically that's what the excise tax, we know what customs duties are. Payroll taxes, well, in the Bahamas, do we have payroll taxes?
Contributions, you said.
Do we have payroll taxes? So we have national insurance. So is that a payroll tax?
Mm-hmm. Yes.
Is it? It's
It's a
similar.
contribution, yeah.
It's similar. But I asked the question, do the contributions collected for NIB go into the consolidated fund? Or does it go to government? So it's like a payroll tax, but we know that virtually all taxes collected go into a consolidated fund. In this case, no, it doesn't. And then we have to consider how is it used. It's used for a specific benefit for the contributors to the fund. It's not used for general expenditures of the government or for paying debts of the government. So it's similar, but it's not quite the same. I think the IMF has pretty much called it a payroll tax, but it's not quite the same. And then, of course, we have the stamp duties, which are payable in a number of situations in the Bahamas. Most important of these are company and corporation, real estate transactions, and overseas remittances of Bahamian currency. Overseas remittances resulting from conversion of Bahamian currency. We have the stamp duty on real estate transactions, which ranges from 2% to 10%. As I said, with the introduction of value-added tax, 7.5% of that is booked as VAT, with the remaining 2.5% in the stamp duty. Real property tax, that's levied on land and real property, and in particular, developed real estate in New Providence. Now, it's interesting with real property tax because it's not uniform. And I think real property tax is probably the only tax that comes to mind that one can say is probably discriminatory against foreigners. Because real property tax is levied on developed real estate in New Providence, but not undeveloped real estate. And I don't know about the Family Islands. I'm looking at a note. It's also levied on developed real estate in other islands in the Family Islands, except Freeport. But it is also levied on undeveloped property in the Family Islands if owned by non-Bahamians. It's also levied on undeveloped real estate on New Providence owned by non-Bahamians. So it is just discriminatory in that effect. And of course, property owned by charities, churches, as well as foreign government is exempt from the real property tax. And also, there is a real property tax cap, and I believe it's now 50,000, which applies to any given or any particular property, regardless of its value. The real property tax liability cannot be greater than the $50,000. There's some other tweaks to it. I've seen the citizens get allowances or breaks, and there's different ways in which they apply to multi-purpose structures. So, real property tax is another relatively large tax generating method, revenue generating method for the government. The others are not as important, except for business license tax. And we call it business license tax now. It was born as business license fee. Is that direct, indirect? Is that progressive, regressive? Is it direct tax?
But business license direct. It's based on your income.
When we say you mean a business, even in the context of a business. The challenge is that it's calculated on the gross revenue. So is that really based on how much I'm making? Or how much my business is making? Is that really based on the wealth of my business? The reality is no. And the IMF considers it to be an indirect regressive tax. Because at the end of the day, what happens is that if you're going to charge a tax based on my gross revenue, which is basically my sales price, I'm just going to pass it on. I'm going to increase my sales price sufficiently to pass it on, and I'm collecting it from my consumer. So, business license tax is regressive. It's just like any other consumption tax. It affects the price, and that is something that the IMF have concluded. Appropriately, we term it a tax and no longer a fee. I have my own views as to what a fee is. A fee is when you're being charged basically to cover the administrative cost of doing something for you. That's a fee. But if you're just raising general revenues for the government, that's a tax. So it's ineffective, inappropriate, and it ought to be reformed. In its economic paper on tax policy for developing countries, the International Monetary Fund had stated that the ideal tax system in these countries should raise essential revenue without excessive government borrowing, and should do so without discouraging economic activity and without deviating too much from tax systems in other countries. That's the view of the IMF several years back when it studied taxation systems for developing countries. So income tends to be unevenly distributed within developing countries. Although raising high tax revenues in this situation ideally calls for the rich to be taxed more heavily than the poor, the economic and political power of rich taxpayers often allows them to prevent fiscal reforms that would increase their tax burdens. This explains in part why many developing countries have not fully exploited personal income and property taxes, and why their tax systems rarely achieve satisfactory progressivity. In other words, where the rich pay proportionately more taxes. By the way, this was written before the 2018 budget. But it's very, very interesting. So, how do we select the right tax system? I just want to go back to what I said. Income tends to be unevenly distributed within developing countries. We know that because the opportunities in developing countries are such that persons can take advantage and exploit the opportunities. And so you have the very wealthy, and you have the poor. People argue that Haiti has been developing for a very long time, but it's still in that category of developing country. And we have a large variation in income in places like Haiti. But although raising high taxes in this situation ideally calls for the rich to be taxed more heavily than the poor, the economic and political power of rich taxpayers often allows them to prevent fiscal reforms that would increase their tax burden. That's just reality. So, all right, turning to the composition of tax revenue. we find ourselves in an area of conflicting theories. The issues involve the taxation of income relative to that of consumption. And under consumption, the taxation of imports versus the taxation of domestic consumption. So in developing countries, where market forces are increasingly important in allocating resources, the design of the tax system should be as neutral as possible so as to minimize interference in the allocation process. The system should also have simple and transparent administrative procedures so that it is clear if the system is not being enforced as designed. The IMF, again, in its paper on the tax policy for developing countries, concluded that in developing countries, tax policy is often the art of the possible rather than the pursuit of the optimal. It is therefore not surprising that economic theory, and especially optimal taxation literature, have had relatively little impact on the design of tax systems in these countries. Nothing new under the sun. Tax policy is the art of the possible rather than the pursuit of the optimal. And is that what we see? So remember, I had initially started off by presenting you with the principles of the tax policy, the 8 or so principles of neutrality, efficiency, certainty, simplicity, effectiveness, fairness, flexibility, and equity. It would be worthwhile for you to contemplate, how does the Bahamas' implicit tax policy measure up to the fundamental principles of taxation, principles of taxation identified by the OECD? That's something I think you should contemplate. Does our implicit policy have neutrality in it? Does it have efficiency in it? Is it efficient? Does it have certainty, simplicity, effectiveness, fairness, flexibility, and is it equitable? So perhaps you can contemplate that, and maybe I can have your views next week. In as much as I have about an hour left, I'm going to jump ahead to the next section.
You serious with this? Like?
Notice I did say an hour and a half. No, but you go until what, 12 or 12:30?
12, yeah.
We start at 9:30. I thought it was 3 hours. 9:30 to 12?
Yeah.
All right, let's see how far we will get there. You know, your introduction keeps coming to mind.
Good.
All right. Push through, and I'll probably do it a bit. So, the topic then is tax revenue issues. what are our tax revenue issues in the Bahamas? Again, for proper perspective, these issues are, for all intents and purposes, pre-VAT. Because it's a lot of these issues that led us to necessarily having to change our tax system and into something like that. So, major tax issues facing the Bahamas for the past several years. 1, year-over-year budget deficits. 2, increasing public national debt to GDP ratio. And most of these have not really, these have not gone away, but in some respect, they have decreased in terms of their significance. 2, increasing public national debt to GDP. 3, a low tax haul as a percentage of GDP. 4, very narrow tax base. 5, inefficient and ineffective tax collection efforts. And 6, high tax exemptions as investment incentives. So, in January of 2014, the IMF produced a paper on the Bahamas called Tax Reforms for Increased Buoyancy. This paper analyzed and highlighted many of the concerns with the Bahamas' tax structure. It's very easy to see these concerns once you throw some numbers up and look at what I call national fiscal indicators. And looking at the years ending 2011, 12, 13, 14, 16. And you can see that these indicators show significant and continuous budget deficits. So when we look at the revenues, we see the revenues for the most part have remained fairly flat until 2014, 2015. But we know why that increased. Because 6 months of that is back. So for the most part, it's been relatively flat. Expenditures have had a reasonable increase, but not too substantial. The deficit, around a 400, increase a little bit there, 400 to 500 million dollars. As a percentage of GDP, the deficit continued to increase and then dropped a little bit there. So, our debt continued to increase because the mathematics of it is such that if you have a deficit, you have to borrow. So, as long as you have deficits, your debt is going to be going up. So the debt continues to grow. And consequently, the debt as a percentage of GDP continued to grow. In 2014, the deficit began decreasing and the rate of reduction picked up significantly for the budget year of 2017. So here we see that the rate of increase has dropped off, but then it started to pick up again. And in 2015, with the introduction of VAT, it began to even off again. So this does not paint a very good picture, particularly in the years before VAT. Increasing debt, budget deficits of $400 to $500 million, flat revenues, hence the need for additional government revenue. And there came about So here, 2014, 2015, these are numbers very similar to what you would have seen before, where the government had to increase its revenue with the introduction of value-added taxes, which in 2014, 2015, we had just over $200 million, and then the $600 and something million in 2015, 2016. Modest increase was projected in 2016 and 2017. But essentially this was really the argument for value-added taxes. If we look at the national debt over, this is about 10, 12 years, we see the same story. The trend line just keeps going up. National debt just continued to increase to the point of being over $6 billion. So over the past 15 years, national debt has continuously increased year over year. And for the most part, each of the components of the national debt, that is the direct charge and government guaranteed debt, have also increased over that period of time. Consequently, the debt to GDP, and this is a typo, it's not the Great British Pound. The national debt to GDP, graphing it, and we accountants and finance people, we like to see graphs. So it just continues to go. We like looking at trends. So, national debt, except in this year, and I'm trying to remember what happened here. I think I know what happened. But it just continued to go up. I think that, does anyone know? Who's the real finance person? Let me throw some reminders. Ingram. Did I hear? Did I hear? BTC. I think that was the sale of BTC, which I think generated maybe about $200 million that impacted the dividends. That's my recollection. But you know, the Bahamian economy continues to recover from the global deficit, the global financial crisis, which began in 2008. Real GDP projected to grow at about 0.5% in 2016, and I think 2018 it's projected to be 1 point something, 1.3%, I think it is. So 0.5% in 2016, 1% in 2017, and about 1.3% in 2018. But despite the growth rate, the total public debt continues to rise. As I said, that will happen as long as we have deficits. And as that rises, so does the debt to GDP ratio, reaching, projected to reach 79%. Sorry, it did reach 79% in 2016, and then projected to decline thereafter. Now, I must point out, and I don't have my additional notes with me, but in the communication for the 2014-2015 budget, the Prime Minister at the time made the statement, with public debt interest draining some $260 million of our annual budget and potentially trending yet higher if we fail to act, we will reap the true fiscal dividend of our fiscal plan by reducing the burden of debt and thereby the annual exorbitant burden of interest rate. Let me just read it again. I think I paused the wrong place. With public debt interest draining some $260 million of our annual budget and potentially trending yet higher if we fail to act, we will now reap the true fiscal dividend of our fiscal plan by reducing the burden of debt and thereby the annual exorbitant burden of interest payments. So that's what he was saying about the government's plans to introduce additional taxes. So while and so he went on to say, with public debt interest draining 260 million. That's the same quote I just read. In 2016, the IMF, on their review, had commented that the public debt to GDP ratio will remain elevated but sustainable in the medium term as the fiscal position strengthens. So while the public debt remains unacceptably high, the Prime Minister had said, he is pleased to note that through our fiscal plan, we will have arrested the rise in that burden in the 2016-2017 fiscal year, with its first reduction in many years, and thereafter the ratio of debt to GDP will decline steadily. Now, what I wanted to mention was that in 2018, we have seen a different set of numbers. The debt to GDP ratio has changed. And it has changed because we have recomputed our level of GDP. The level of GDP that we've been working with for a number of years has been around $8 billion. But we have re-estimated our GDP to be around $12 billion. So that was a significant increase. As a result of that increase, our calculation of debt to GDP has dropped substantially. So whereas we were looking at debt to GDP of being around 79–80%, by changing the denominator, our debt to GDP is now in the upper 50s, probably about 58%. So from a numbers perspective, our debt to GDP ratio is not as terrible as it was. I haven't done the research on how we changed the GDP, but I accept that that's what the government is saying the GDP is. And it's not an easy number to identify, and that's why it tends to be fairly fixed for years. I know when I was doing my slides, my schedules, it was very difficult to find anywhere where someone was saying what the actual GDP is. In some cases, I had to deduce it from numbers taken by IMF and whatnot. But we're looking at 12 billion. So, which is good. What I would like to know is, of that 12 billion, what percentage of that is domestic? The domestic economy, what percentage is in the international economy? And then you can extrapolate, when you look at your taxes, where are we getting our revenue from? And I suspect we're still getting it from the smaller portion of the pie. So, we understand where we were with respect to pre-VAT years. We understand the need to increase our level of revenues. But remember, I also said that one of the issues was the fact that the Bahamas had a low tax form as a percentage of GDP. And when we did a comparison of the Bahamas' tax revenue compared to its GDP and looked at around the region, we can see from table 2 here that the tax revenues as a percent of GDP for countries in the region and the rest of the world, in 2008, 2009, the Bahamas' ratio was 16.5%, which was the lowest after Central America. Not far off, but it was the lowest in the region. So that tells us that we have the ability to raise more revenue, or we should be raising more revenue in terms of taxes as a government. Now, if we were to look at the tax revenue for recent years, and I've just done the calculation, it's not on the screen. In 2013 and 2014, the revenue or the percentage increased to 16.9%. In 2014, 2015, it increased to 19.5%. And with the introduction of VAT, it's expected to climb to about 21%. That's where they were targeting with value-added taxes. So, the Bahamas' low tax haul of less than 17% compared to an average of the CARICOM of 22%. And although the Bahamas ranked 19th in terms of per capita, it ranked only 92nd out of 98 countries in terms of its tax effort. So the Bahamas is estimated by IMF to utilize only 39% of its tax capacity. The low tax effort, and given the high GDP per capita, implies large potential to increase tax revenue. So in essence, the Bahamas has low taxes compared to the rest of the world, excluding Central American countries. Many countries in the region introduced VAT a number of years ago, thus providing a stable source of tax revenue. Almost all the countries in the region have taxes on income and profits, that is direct income taxes. The Bahamas ranks 19th in terms of per capita to GDP, capita GDP in the world, despite the slow growth in incomes. However, in terms of its tax effort, it ranks 92nd out of 98. Now, what that means is that the tax effort is defined as the ratio of actual tax collections to GDP relative to the tax capacity of the country. The country utilizes only 39% of its tax capacity, and its tax capacity is the maximum attainable tax to GDP given the economic structure of the country. So these are some statistical numbers that are calculated that the IMF likes to use in order for them to determine, to assess where do you stand in your capacity to raise taxes, and then secondly, your effectiveness as far as your efforts go in increasing your taxes. Countries with a higher level of GDP per capita and public expenditure on education in particular, as is the case in the Bahamas, are near their capacity, near their tax capacity, and have a higher tax effort. Countries such as Sweden and Denmark utilizes 98% of their tax capacity, whereas, as I said, the Bahamas is down to 39% of its tax capacity. So the low tax effort implies that there is substantial potential to raise revenues, that is additional taxes, in the Bahamas. Given the current income level, there is a large potential to increase tax revenues. And this is all the analysis leading up to the introduction of value-added taxes. However, the tax capacity utilization can only improve over time with a well-implemented plan that expands the tax base and removes some of the distortions, thus stimulating economic growth. So that comment was that we can only increase our taxes by implementing a plan that expands the tax base. So what is one of the other major issues facing the Bahamas? A very narrow tax base, which is primarily international import of goods. So prior to that, tax collection was on a very narrow base without personal or corporate income taxes, nor a comprehensive consumption tax. Taxes were predominantly levied on goods and not services. The service sector of the Bahamas contributes a significant part of the GDP, but for the most part was not being taxed. 1/3 of tax revenue was obtained from import duties and 52% from duties plus excise and stamp taxes. We saw those numbers. This heavy reliance on border taxes created a very narrow tax base, taxing only goods and produced an inadequate level of revenue. So the Bahamian tax system restricts its policy options. In addition, due to its reliance on trade taxes, the tax system is susceptible to external shocks as observed in 2009. The government's decision to introduce a VAT system and reform other key taxes like property taxes would improve government tax revenue as well as the efficiency of the system. As I mentioned, duties, excise, and stamp taxes accounts for approximately 52% of the total revenue in the year 2013-2014. However, after the introduction of VAT halfway through the admin year of 2014-2015, that group of duties, excise, and stamp taxes declined to approximately 31%, with VAT jumping to 33%. However, the tax revenues were mainly obtained from international trade and transactions. Taxation of trade and transactions through stamp duties and fees raises the cost in the economy and has a cascading effect on taxes. So we have the fourth major issue for the Bahamas, which was the narrow tax base. And it is interesting that, as most of you would know, as the Bahamas was ceded to its WTO, the same customs duties and the revenue earned from them would have to decrease, because one of the requirements for WTO accession is to not discriminate about trade coming into your jurisdiction, and therefore border tariffs have to be reduced, reducing our customs duties and diminishing the overall revenue for the government. It was interesting, also in the 2014-2015 budget communication, the Prime Minister at the time had acknowledged in his statement that it is widely acknowledged that the administration of our current system of taxation is grossly deficient in terms of the efficiency and effectiveness of processes and procedures as well as the successful collection of monies that are rightfully due. So that was the Prime Minister acknowledging that the government's efforts in collecting taxes was not efficient, nor was it effective. Major tax revenue issue number 5. Inefficient and ineffective tax collection efforts. In particular, there is a low compliance with tax policies for business license fees and for real property taxes. A substantial amount is outstanding for real property taxes, although these numbers are merely estimated and were not verifiably determinable. Business license fees is considered an inefficient tax on consumption. So, inefficient and ineffective tax collection efforts with respect to business license fees, which are considered by the IMF as a consumption tax. As I said earlier, it's based on gross sales. It's based on the prices of the items that you sell. Although it is a tax paid by the business, it is not levied on the income of the business, but rather on the turnover, which equates to the level of consumption. The business license fee paid by the business results in higher prices for consumption. The opportunity also exists, and so does the inclination, for businesses to understate its turnover when filing a return, thus contributing to the low compliance with the tax policy for business license. So the business license fee as a broad-based consumption tax yields very little revenue. In 2010-11, it raised about $111 million, or 1.4% of GDP. In most years, it accounts for less than 10% of total revenue. And that is really your major, if not your only, business so-called fee, or your business taxes, which accounts for less than 10% of the total revenue. It's interesting, you compare that to value-added tax, which I consider to be the major general consumer tax. I would like to think that the vision is that basically value-added tax is going to be the consumer tax. But that tax accounted in 2015, 2016 for 33% to total revenue. The business tax accounts for 10%. So, do we have equity? And the way I look at it is that you get a tax in any society or economy. You're going to tax your individuals and you're going to tax your businesses. So in this case, the individuals are being taxed up to 33% and the businesses are being taxed 10%. So of the 10% in total revenues derived from business license fees, about half of this is raised from 3 sectors: banks, insurances, and telecommunications. The scope to raise the rate for business license fees without introducing significant distortion is limited, given the structure of the tax. There are also weaknesses in the administration of business license fee. Time doesn't permit, but my view is that business license tax needs to be removed and replaced with good old corporate income tax. We'll get into that conversation a little bit on another occasion. But I think that's one way to make our tax system stronger. Now, I mentioned that one of the other inefficient and ineffective tax collections was real property tax. So, real property tax collection, although doubled as a percentage of GDP since 2002, remained flat for the last several years at 6 to 8% of total revenues. The system of administration and collection remains inefficient, resulting in significant amounts not being collected. Since 2008, arrears have increased annually by an average of 28.5%, from 28 million to 97 million in 2013, as estimated by IMF. We do not know exactly what the outstanding real property tax amounts are, but the IMF, in their analysis, had estimated it in 2013 to being around $98 million outstanding. In 2013, 131 million was assessed on total property valued at 14.6 billion. Of this amount, 35 million was collected, which is the efficiency ratio of about 26.5%. So the Bahamian real property tax system effectiveness has eroded through a number of design and administrative shortcomings. In 2011, it was suggested that with innovation and improvements in the property tax administration, property tax revenues could be doubled to 2.4% of GDP. So, if we look at a table that the IMF had produced in looking at and analyzing real property tax based on the property valuations, I'm not sure how clear this is for you to see, but property values over here up to 100,000, 250,000, 500, 1 million. And what is important to note is the arrears. This is their calculation of the arrears according to the classes of the property. So for properties up to 100,000, they had estimated roughly $6.6 million of real property tax was outstanding, which is about 7% of the total arrears. Total arrears was about $96.5, $97 million. What I found interesting is that if I looked at properties of $1 million or greater, roughly 56% of the arrears are for these properties valued of $1 million or more. So although we have $97 million outstanding, half of it is from $1 million and up. One would think that persons with properties of $1 million and greater have a greater ability to pay their taxes. But yet, they are able to remain outstanding to the tune of 56% of the total amount. So the issue of arrears and low coverage ratio is evident. The IMF's report showed arrears increased since 2008 by, as I mentioned, an average of 28%, and an alarmingly 56.1% of the arrears are for properties valued $1 million and above. Now, I don't know where those properties are located. What does that say? We only report, you know, decide. So the administrative side of the real property tax is strongly supported by government's resolve to enhance property tax collections. With a comprehensive multi-year strategy for the property tax system that will entail amendments to property tax legislation, implement business process re-engineering in all areas of the system to bring them up to modern standards, and to expand enforcement. That's all that is to say that the government at that time had indicated a plan to address real property tax shortcomings. And I think that they had began that. They wanted to re-engineer the whole process of going about determining, assessing properties, etc., which I think they have done. They were also embarking on having property valuations done. And I believe that is continuing. Lastly, the sixth major tax revenue issue in the Bahamas that I had identified was high tax exemption as investment incentives. So, here, we know that the IMF noted that in the Bahamas, there's a very wide range of tax concessions which is used to attract foreign direct investments. These concessions cover taxes such as real property tax, import duties, business license fees, stamp duties, and excises. So, whenever you hear of heads of agreement, indicated in the heads of agreement are concessions. No real property tax for 10 years. No import duties on anything that you need to bring in to build, renovate, etc. Business license fees will be waived for 10 years. Stamp duties waived. So all of these concessions go to FDIs. What is troubling is that even after offering the initial concession, in many cases, it's renewed. After the first 10, 5, 10, 15, whatever span it is renewed. So that's the high tax exemption. Additionally, with the Bahamas not having any income taxes, including capital gains taxes, this serves as another significant tax concession to foreign investment, because they're not paying any taxes on the revenues they earn, on the income that they generate. So if you compare to other jurisdictions where automatically they would have to pay taxes on their income, they are being given a break there as well. The tax concessions, however, further erodes the tax effort for the country and contribute to the narrow tax base on which taxes is being realized. So, as again indicated by the Prime Minister this time in the 2016-2017 budget communication, the need for reform is evident. And he stated that the government remains firmly committed to staying the course with its medium-term fiscal consolidation plan. The plan comprises a multi-year strategy whose overarching objective is to secure durable structural reform of the principal components of the public finances. We have launched major reform exercises in respect of the administration of our major taxes. Not only will these measures lead to an enhanced revenue yield from our tax system, but they will also lead to enhanced efficiency and growth of our economy. And that was Prime Minister Perry Christie's 2016-2017 budget communication, where he recognized the need for tax reform and that the administration had a plan in place. I have to assume that that's continuing. I don't have the analysis of the current administration's plans, but I assume that that's continuing. Obviously, from what's being said in the press, there's been some changes, some tweaks to it. But in essence, these are the major tax issues facing the Bahamas. And as I said, for the most part, they still remain. Maybe they have reduced a little bit in terms of their significance. But there are still year-over-year budget deficits that have to be addressed. There is still increasing public debt to GDP, which the international market looks at. We have modified, or we have recalculated our GDP, so the ratio is no longer as alarming as it once was. It's now down to about 58%. We still have a relatively low tax haul when compared to other countries, even in the region. We have now, with the introduction of VAT, not as narrow a tax base as we once had, but we still have the opportunity to tax other areas within the economy which is not being taxed presently. So we still have the need to expand our tax base, and by so doing, reduce the tax burden on any one individual. We still have inefficient and ineffective tax collection efforts, which still require reform. And we still very much have high tax exemptions as investment incentives for foreign investors. That is a major, major area for the Bahamas in terms of how it deals with FDIs. This is the ideal place to start, because the next session is actually speaking about FDIs. So we'll go into a little bit more detail as to FDIs. We don't have a case study, but maybe that's something that we will arrange to do at some point, where you take one of these FDIs, like a Bahama, and do a case study and analysis of it. Because the big question is always, how much have we given up, and what are we getting back? And that is the, almost that $1 million question. That's probably more like $150 million question. In fact, it's probably as high as $1 billion. It'd be interesting to really analyze the amount, the value of the concessions. And if I was a finance minister, I would have an analytical team in the Ministry of Finance that analyzes FDIs. We're going to give tax concessions for 10 years, calculate what that amounts to. What are we getting back? But, ladies and gentlemen, that's it for today. I think I've been relatively close. I've been very relatively compliant with the time period I've been allotted. So, if you have any questions, feel free to ask. I should have said at the beginning that it's fine to ask your questions as we go along. I prefer for the class to be interactive. Makes it easier on my throat. But if you have any questions, then please let me know. Okay, silence, I take it that's not. All right, so next week we will